Okay, folks, welcome back. Lesson 2 of the ICT Mentorship June 2017 content. This is ICT stock trading, building buy watch lists. Okay, so what we have in front of us is the list of the Dow Jones Industrial Composite stock list. This is all 30 stocks that presently make up the Dow Jones Industrial average. And this discussion is going to be highlighting just a focus on these Dow 30 stocks. The same application is obviously done on the S&P 500 and NASDAQ 100, but it's not necessary. You can make all the stock trades you'd need just from the Dow Jones 30 stock list. As we already disclosed in the first lesson, where I gave you the seasonal influences per calendar month, we're going to be focusing on buy watch lists, so there's going to be a focus primarily on the bullish months. We have a few months in here that are bullish, but the primary focus I want you to have is not that we're looking for individual monthly trades, but we want to be looking for areas in which the market will be wanting to trade higher. So we're going to be focusing primarily on two segments of the market in terms of the calendar year. We'll be looking for bullishness, and it's going to be seen in the first half of the year and in the second half of the year. Okay, so building buy watch lists. Okay, so the filter number one we have to know, is the stock market poised to rally? In other words, is it technically sound for you to anticipate the stock market to rally higher? Then filter number two is, during bullish months, we want to be selecting higher low stocks. In other words, stocks that have made a higher low. The February to May months are ideal long swing setups, and the October to January months are ideal long swing setups as well. Now, in my first discussion about stock trading, it was on the free tutorials, how to pick stocks template. It focused primarily on the fall. What we're going to talk about is the spring session here, and we'll also add some things to it to build in some additional insights. Now, the majority of index stocks, generally they rise when the market itself, or major market, rallies or moves higher. In high tide, all boats rise, basically analogy there. So stocks that are trending higher on the weekly prior to our condition of looking to be a buyer, they're going to be ideal scenarios. We want to avoid safe stocks like Verizon, GE or General Electric, or Coca-Cola. Strong stocks will have an obvious bullish structure. The discount arrays with index SMT will highlight companies that are under heavy accumulation during seasonally bullish months. Try to narrow the selection to 2 to 4 companies during your stock selection process. And leadership stocks that are aggressively bought by institutions will be found to fail to drop lower during bullish months when the 3 major stock indices decline until one of those indices fails to post a lower low comparably. So what am I saying here? During periods of seasonal tendencies for stocks to move higher, as we outlined in the previous slide in the previous lesson, those months that are bullish, we're going to be focusing primarily on when the 3 averages are making lower lows, when the NASDAQ, the S&P, and the Dow, one of those averages are going to fail to make a lower low. So that signals the overall market trend change to bullishness. At that same time, we're going to be looking for stocks to make higher highs at that same juncture. If it doesn't occur for that particular stock, then obviously that stock is going to be discarded and not concerned with. So we're focusing primarily on the February to May portion of the year. Okay, and I've already gone through the Dow 30 stocks to save time, because this lesson could easily have been 3 hours long if I allowed it to. So I went through and I filtered out all the stocks that met the criteria of going from January into February, where the Dow Jones, which is the solid line, green line, it's trading lower going in from January 2017, right towards the midpoint of January 2017. It made a lower low, while the Apple Incorporated, AAPL stock, failed to go lower at that same time. So the month of January, Apple was unwilling to go lower when the Dow Jones Industrial Average went lower. So Apple was showing relative strength here, and that only occurs when large institutions come in and they sponsor buy programs. So lots of accumulation, lots of buying took place around that 118, 120 per share. And from February all the way up into May, there was a nice appreciation in the share of Apple, and subsequently went higher into May. And just this month, we've seen it decline at the time of this recording in June. But we see a bullishness on stock market between February and May. We've seen the telltale hallmark sign of accumulation by institutions where they fails to make a lower low against the Dow Jones Industrial, and you can see the subsequent price move with this stock. So between February and May, you can see a very nice rally up and an appreciation in the share price. The next stock that was filtered from going through all 30 stocks, and again removing Verizon, GE, and Coca-Cola, was Boeing. And the same scenario here we see in the month of January, leading into the month of February, where it begins the bullishness. Again, the context is we're going to see them buying early. So if they expect seasonally that February into May generally sees bullishness, the Dow Jones created a lower low in the month of January, but the share price of Boeing was unwilling to go lower in January, so it diverged bullishly. Notice that it gapped up in January, and then that gap was closed in the second trading day of February. Discount array. So we had that fair value gap, traded down, closed into it, and then rallied away. Price rallied up into May. May had our typical decline into the third week of May, then started its movement higher from there, and has since traded even higher from February's low. But look at the bulk of that bullishness that's seen between February and May. Disregard anything happened in May. We're just looking for the seasonal tendencies that gives us a play for a stock trade during the first portion of the year, beginning in February. The next stock that met the criteria of a higher low and bucked the trend that was seen with the lower low in the Dow Jones Industrial Average in January. You can see between February and May, nice little appreciation in the share price. But then notice in May, when seasonal tendencies change from bullishness, it made a high, and it's been trading off rather precipitously on the downside. Another company is Home Depot that met the criteria. In January, the Dow Jones, you can see with that solid line in the background, made a lower low, while the Home Depot shares were failing to make that lower low and diverged around that $135 to $136 share price in January. Then ultimately, that large up day in January, it was creating a liquidity void, and it traded down into it in February, closing that range, fair value gap, discount array, and then you can see obviously the price movement between the February anticipated bullishness beginning and to May, creating a very nice movement higher. Okay, our next one is McDonald's. It's the killer of arteries. The Dow Jones, again, we can see that same lower low being formed here. It's basically the same overlay that's being applied. You can do this from barchart.com. Just add a comparison and do a left axis display on $DOWI. That will give you the Dow Jones Industrial Overlay against any share or company price of a stock. And I have here the lower low showing on the Dow Jones that was seen in January 2017, and the shares of McDonald's were diverging bullishly, that didn't make a lower low in January and rallied higher up. And you can see the really nice movement between February's inception of the bullish seasonal tendency up into a share price of $142 that subsequently kept trading and moved as high as $153 a share. Okay, our last example here that was filtered out of the process. We have the Dow Jones again making that lower low in January, but the share price of Visa was unwilling to make that lower low. And between February and May, we've seen a nice little appreciation between February's beginning and the month of May start. So out of 30 stocks, we've already filtered out a few of them that are just simply not going to be followed. And again, they're Verizon, Coca-Cola, General Electric, and in my opinion, even Microsoft and Intel would be on that list as well, because they're just companies, in my opinion, they're just not exciting anymore. Now, those things may change in the future, but at the time of this recording, I'm not real excited about those particular companies. So we ferreted out basically 6 stocks out of that 30 Dow list, and the first is Apple, the second is Boeing, the third is Disney, the fourth is Home Depot, McDonald's, and the final one and sixth is Visa. So selecting 2 to 4 from this list would be accomplished by selecting call options that were affordable, as well as where each were trading in historical terms. Now, a stock from this list that was too extended from a weekly or daily market structure would eliminate it from the list. And what do I mean by that? When we do low resistance liquidity runs, what we're doing is we're anticipating a run through an old high or a run through an old low, a break in market structure that's already qualified. And therefore, if we're looking for stocks to be moving higher, institutions like to see big breakouts, big movements higher, especially on a weekly chart. If everything fundamentally is suggesting it should be going higher and the major market's suggesting it's going to go higher, and we couple that with a seasonal tendency for the market to go higher, you have blue ribbon recipe for wonderful results. If you have a market structure high that's really higher than where you're going to be entering at, generally you're going to see some lethargic price action. It might move a little bit, but then eventually it'll peter out and either go sideways or actually altogether reverse. Now, quarterly increases in sales and profits would also be a strong factor in keeping a stock on this list. And blending a simple seasonal, fundamental, and ultimately technical trading process for selecting possible winning stocks is the outcome. So we have 30 stocks to begin with. We whittled it down to 6 stocks. So now let's take a closer look at these individual 6 stocks. Okay, the first on the list is Apple Incorporated. As you can see here, we had an old high back in the 2015. And at the time of the seasonal tendency for 2017's February month, price was trading in a position where it was poised to break out, and as a low resistance liquidity run above 135, we can anticipate institutions to step in to do that very thing and see a breakout. So this stock was actually very strong from a weekly standpoint, because each one of these bars are a weekly representation of the share price movement for Apple Incorporated. You can see the overall movement higher. Every down close candle was supporting new buying from April 2016 all the way leading up into February, where they finally made an expansion and ran right through the 135 and ultimately always all the way up to 155 per share. Next one is Boeing. Again, very similar. We had an old high back in 2015. Market was consolidating. We saw a price run down below the 120 level, clearing out sell stops. And then we started seeing institutional order flow supporting down close candles. Up close candles were being broken. We have very clean levels at 150 and the old high around that 160 level. Ultimately, as we moved into our bullish seasonal tendency in February 2017, the market was sitting right at old highs, perfectly ripe for a breakout. Institutions love this setup. They will buy a lot of it if it's fundamentally sound as a company. Obviously, Boeing is. And from $160 a share all the way up to ultimately $200 a share, it looks like. So long and short is very, very good price movement. The weekly scenario here, again, fits the bill. So Apple and Boeing so far are really strong candidates, or would have been strong candidates. Let's say it like that, Michael. Keep it in proper perspective because everything we're teaching is hindsight. Okay, our next one is Disney. And I want you to look at this one here. Okay, we have the 2015 highs around the summer, and then we have a November high around that 120. So it looks like they're having difficulty at 120. And then price made a short-term low in April 2016, May time period. And we were right at that point of breaking out above that, but we had a really weak market structure because we have already blown through a short-term high. And while we did have equal highs around 120, it was far less likely to see it appreciate based on comparing what we saw in Apple and Boeing, where it was very clean highs and it was already near the highs. This would had to have it rally about $15 before it even gets to the old high seen in 2015. So it has to have a lot more movement to get to a new breakout. Institutions won't be that aggressive about buying this type of stock because it's not poised technically, regardless of what the fundamentals may be. They have to wait until it gets to a technical level like that 120. Incidentally, the first part of this year in 2017, all the talking heads were calling for 120 and 125, and that was a built-in sentiment idea as a contrarian idea. It went to a little bit over 116, and then it's been trading softer since. So as contrast, look at what this weekly chart was showing you versus what was shown in Apple and in Boeing. If you have to, go back and rewind the video to the portion where it showed the Apple and Boeing individual charts, and you'll see there's a glaring difference between what we see as the old highs here at 120. It would have to gain a lot more ground versus where Apple and Boeing were at the time of February 2017 bullishness. Home Depot, again, very similar to Boeing and Apple at the time of the February 2017 bullishness, seasonal tendency, and when the Dow was making a lower low, Home Depot was not willing to do that, and we were real close to the old high. You know what's going to happen. Institutions are going to step in, buy it, surge it through, nice breakout, $20 a share appreciation. Okay, next one here, McDonald's. And we can see at the time of our bullishness in 2017, we had price trading just inside of a larger consolidation. And we can see price had already respected a bullish order block around that 120 and anticipating a low resistance liquidity run to around that $132 a share price, and finally broke out a few months later and had a very aggressive run above 132, trading as high as $155 a share. Really nice. So this one, coupled with Apple and Boeing, Home Depot as well, very strong. So there's 4 candidates right there. And the final one here is Visa. Very similar. We're looking at the time of 2017's February bullishness anticipated. Visa was trading really close to its highs, and ultimately they surged price through, and ultimately seeing it appreciate about $10 a share. So while this one was a little lethargic, nonetheless it still met the criteria as far as looking for higher moves on the weekly chart. The structure was sound, and while it didn't deliver as high as a share return appreciation that the other 4, McDonald's, Home Depot, Boeing, and Apple did, it still was very favorable in terms of the ferreting out process that we're outlining here. So when we go through the process of going through the February to spring highs in the stock market, you'll begin with the Dow 30. You can do the NASDAQ 100 the same way, and the S&P 500. Now that one's going to take a little bit more work to go through, but you'll have a lot more stock selections to choose from. Now, once we get through the process of picking out which ones have a potential weekly breakout, and yes, I'm saying breakout because stocks are predisposed to trade higher. And if you have a fundamental basis to expect prices to go higher as a whole in the stock market, and you're looking at seasonally to go higher, and you're looking at relative strength ideas supporting with the SMT divergence between the indices, and that stock is showing an unwillingness to go lower, you have every portion of a winning recipe for that stock to go higher. Doesn't mean that you're going to be right. This means that statistically speaking and historically speaking, these elements are there all the time for winning stocks. Until next time, I wish you good luck and good trading.